In the weeks before the bombs fell on Iran, something unusual happened in global oil markets that almost nobody noticed at the time. Saudi Arabia, which had agreed alongside its OPEC Plus partners to freeze production during the first quarter of 2026, quietly began increasing output anyway. Bloomberg's production survey, based on ship tracking data and information from officials, showed that in February 2026, Saudi Arabia raised production by 340,000 barrels per day, bringing total output to 10.34 million barrels per day. OPEC's own secretariat reported an even larger figure, showing Riyadh had notified the group of a boost of approximately 782,000 barrels per day. Tanker tracking data confirmed what the numbers suggested. Saudi Arabia and other Gulf producers were ramping up exports in the weeks leading up to the joint American-Israeli strikes on Iran, filling tankers faster than at any point in recent months. This was a country that had read the intelligence, understood what was coming, and made a decision that would alter the architecture of global oil markets in ways that will last for decades. Because what Saudi Arabia did in those final days of February 2026, and what it has been doing every day since, represents the most consequential shift in Saudi export strategy since the kingdom built its east-west pipeline during the Iran-Iraq War of the 1980s. And wrapped inside that shift is a question that energy markets, oil-importing nations, and global investors are only now beginning to fully process. Is the global oil market headed for a crash? And is Saudi Arabia, the country with more power over oil prices than any other on earth, deliberately engineering one? The answer requires understanding not just what Saudi Arabia is doing today, but why it is doing it, what it stands to gain, and what the rest of the world stands to lose. To understand the export strategy shift, you have to understand the market Saudi Arabia was navigating before the Iran war disrupted everything. Heading into 2026, the picture for global oil looked genuinely bearish. The International Energy Agency had projected an implied oversupply of 3.8 million barrels per day for 2026. American shale production was growing, Brazilian offshore output was climbing, Canadian oil sands production was expanding. Non-OPEC producers across the Americas were adding supply at a pace that threatened to overwhelm whatever demand growth existed in a global economy still navigating the aftershocks of elevated inflation and slowing industrial activity in China. OPEC Plus had spent years cutting production, collectively removing nearly 5.85 million barrels per day at the peak of its restraint in early 2025 to keep prices from collapsing. But even with those cuts, the trajectory of supply growth from countries outside the alliance was creating a structural pressure that cuts alone could not indefinitely resist. Saudi Arabia's leadership understood this. Crown Prince Mohammed bin Salman and the technocrats at Saudi Aramco and the Ministry of Energy had been watching non-OPEC supply growth with growing concern. Every barrel that American shale producers, Brazilian deepwater platforms, and Canadian oil sands operations added to global supply was a barrel that did not require Saudi oil. And with Vision 2030's economic transformation program requiring sustained government revenues, the kingdom could not afford to simply cut its way to irrelevance while other producers captured market share it had sacrificed to support prices. The strategic calculus that Saudi Arabia had been developing through 2025 was therefore fundamentally about a choice between two visions of the kingdom's future in global oil markets. The first vision was the traditional OPEC approach: manage supply carefully, support prices above $80 per barrel, protect per barrel revenues, even if that meant ceding market share over time. The second vision was more aggressive and more strategically complex: accept lower per barrel prices in the short term in exchange for defending and expanding market share, using Saudi Arabia's unique position as the world's lowest cost major producer to outcompete higher cost rivals and potentially trigger the market share consolidation that the kingdom believed was necessary for long-term relevance. During 2025, OPEC Plus had already begun moving in this direction, implementing a series of production quota revisions that collectively raised the bloc's output target by 2.9 million barrels per day. This was not a sudden reversal of strategy. It was a calculated incremental pivot, and Saudi Arabia was leading it, not following it. Then February 28th changed everything, and Saudi Arabia's export strategy shifted from a long-term market positioning play to an immediate crisis management operation, with consequences no one had fully anticipated. Within hours of the first American and Israeli strikes on Iran, Saudi Arabia activated a contingency plan that had been sitting in operational readiness for decades. The East-West Pipeline, a 1,200-kilometer network of steel and concrete running across the breadth of the Arabian Peninsula from the oil-rich eastern province to the Red Sea port of Yanbu, roared to life as Saudi Arabia's primary export artery. Built during the 1980s, specifically because Iranian threats during the Iran-Iraq tanker war had demonstrated what a Strait of Hormuz closure could mean for Saudi revenues, the pipeline had been maintained, upgraded, and kept in operational readiness for precisely this scenario. Analysts described what happened next as a strategic masterstroke. Saudi Aramco began rerouting crude shipments through the pipeline within hours, diverting flows away from Gulf terminals that were now in the zone of Iranian retaliation and toward Yanbu, which sits on the Red Sea, entirely outside Iran's reach. A flotilla of supertankers assembled off Yanbu's coast. More arrived daily as global buyers scrambled to adjust logistics. By late March 2026, Saudi Arabia's east-west pipeline had reached its full operational capacity of 7 million barrels per day, a technical milestone that represented the culmination of decades of contingency planning becoming operational reality. Of those 7 million barrels per day flowing through the pipeline, approximately 5 million reached export customers at Yanbu, while 2 million were directed to Saudi refineries for domestic processing. An additional 700,000 to 900,000 barrels per day of refined products were also being exported through the Red Sea route. The numbers matter because they reveal the extraordinary scale of what Saudi Arabia achieved under conditions that had forced every other major Gulf producer to cut output dramatically. When the Strait of Hormuz effectively closed in early March, Kuwait Petroleum Corporation declared force majeure. Qatar Energy declared force majeure. Bahrain's Bapco Energies declared force majeure. Production at Iraq's 3 main oil fields in southern Iraq dropped 70% from 4.3 million barrels per day to 1.3 million. The UAE reduced output. Gulf Arab states collectively cut production by at least 10 million barrels per day. Saudi Arabia itself was forced to reduce total production by 20% from 10 million to 8 million barrels per day because some of its offshore loading terminals in the Gulf had been disrupted. But while every other producer was simply shutting in production with no alternative, Saudi Arabia was redirecting its output through a pipeline that gave it a functioning export route when everyone else had none. The competitive implication was stark and immediate. Saudi Arabia became, for a period of weeks, the only significant Gulf producer that could consistently export crude oil to international markets. By controlling access through the strait, Iran had inadvertently handed Saudi Arabia a temporary monopoly on Gulf oil exports. Lucila Benila, lead emerging markets economist at Oxford Economics, noted the strategic dimension. The war had accelerated investments in bypass routes, and as other countries rerouted, Iran's main strategic leverage would weaken. But in the immediate term, the advantage was Saudi Arabia's. The global oil price response to this supply shock was the most violent in market history. Brent crude, the international benchmark, had been trading in the low 70s before the crisis. Within days of the strait closure, it crossed $100 per barrel. By early April, it reached $128 on a single day, the largest monthly gain in the history of oil markets. The IEA's April report noted that North Sea-dated crude was trading around $130 per barrel at the time of writing, $60 above pre-conflict levels. Japan, which obtains approximately 95% of its crude oil from Saudi Arabia, Kuwait, the UAE, and Qatar, and delivers roughly 70% of that through the Strait of Hormuz, was in a near-emergency situation. Japanese refiners asked their government to release strategic stockpiles. Pakistan officially requested that Saudi Arabia reroute oil supplies through Yanbu on the Red Sea, with Saudi authorities providing assurances and arranging crude shipments through the bypass route. The IEA nations, which include the United States, Japan, Germany, and others, agreed to release an unprecedented 400 million barrels from emergency oil reserves. Even with that release, prices remained historically elevated because the underlying supply disruption was simply too large for any reserve release to offset. This is the context in which the question of a global oil market crash must be understood. The crash risk does not come from the supply shock itself. High prices caused by supply disruption are painful but comprehensible. The crash risk comes from what happens after the disruption ends, because the scenario that energy economists are now modeling with genuine alarm involves a sudden reversal of the conditions that have driven prices above $100 per barrel, combined with the structural changes that the crisis has accelerated in ways that may permanently alter global oil demand patterns and supply routes. Consider the demand destruction already underway. Asian economies, which are the world's largest and most rapidly growing oil consumers, and which import the overwhelming majority of their energy through the Strait of Hormuz, have been forced by the crisis to confront their vulnerability in ways they had previously managed to avoid. Japan, South Korea, China, India, and the smaller economies of Southeast Asia collectively receive the majority of their crude through the strait. With that route disrupted, some have faced genuine supply shortages, others have drawn down strategic reserves, and all have been forced to pay dramatically higher prices for whatever supply they could access. High prices suppress demand. Slowed economic activity suppresses demand further. Every airline that reduced flights because jet fuel became prohibitively expensive represents destroyed demand that does not automatically return when prices fall. Every factory that cut production because energy costs made marginal operations unviable represents industrial demand that may not recover quickly. The demand destruction that oil prices above $100 per barrel create is real, measurable, and cumulative. Now consider the supply picture on the other side of this crisis. Before the war began, the IEA had projected a global oil oversupply of 3.8 million barrels per day for 2026, driven by production growth from the Americas and a slowdown in demand growth. That oversupply was paused by the crisis because physically shutting in 10 to 14 million barrels per day of Gulf production more than offset any amount of non-OPEC supply growth. But the non-OPEC supply growth did not stop. American shale producers, whose break-even costs in the Permian Basin run as low as $30 to $40 per barrel, were actually benefiting from elevated prices. Every day that Brent traded above $100 was a day of extraordinary profitability for producers who could deliver oil without going anywhere near the Strait of Hormuz. American production continued growing. Brazilian offshore output continued its expansion. The supply that was going to create the oversupply has not disappeared. It has been masked by the disruption. And when the disruption ends, whether through a negotiated settlement, a ceasefire, or a reopening of the strait, all of that supply returns to a market that has simultaneously been experiencing demand destruction from high prices and a potential acceleration of energy transition investments prompted by the crisis. 4. Saudi Arabia's export strategy must be understood against this backdrop because Riyadh is making decisions today that will shape where it stands in global oil markets when the post-crisis oversupply reasserts itself. The kingdom's decision to maximize east-west pipeline flows was not only a crisis response. It was a demonstration of capability and reliability that will shape Saudi Arabia's commercial relationships for years. Every cargo that arrived at Yanbu during the crisis, on time, at contracted prices, to buyers who had feared their supply would be cut off, represented a strengthening of the commercial and political relationship between Saudi Arabia and that buyer. Japan, South Korea, Pakistan, European importers who had scrambled to find alternative supply, all of them learned something from this crisis that they will not forget. Saudi Arabia has an alternative export route, and it works. That knowledge transforms the kingdom's commercial position in a post-crisis world. But Saudi Arabia is also accelerating its thinking about expanding and securing that alternative route for the longer term. The kingdom is actively considering expanding the East-West pipeline, which currently carries 7 million barrels per day, to handle even higher volumes. The Gulf Cooperation Council states, confronted with the reality that Iran's ability to close the strait represents an existential threat to their economic models, are reviving American-led plans for the India-Middle East Europe Economic Corridor, known as IMEC, a multimodal corridor that would run from India through the Gulf and then to the Israeli port of Haifa and from there to Europe. A corridor of this kind, if built to full operational capacity, would provide an alternative to Hormuz that no single actor could unilaterally close. The market share dimension of Saudi Arabia's strategies requires attention because it connects the immediate crisis response to the longer-term question of where oil prices go after the disruption ends. Before the crisis, Saudi Arabia had been part of an OPEC Plus strategy of gradually restoring production that had been cut during the years of output management. The April 5th OPEC Plus meeting agreed to add 206,000 barrels per day in May. But the actual effect of the meeting was almost entirely symbolic, as the Stars and Stripes reporting noted, because most OPEC Plus producers were physically unable to increase output given the Hormuz disruption. Saudi Arabia was the only member with meaningful spare capacity, approximately 3 million barrels per day, that could theoretically be deployed. Halima Croft of RBC Capital Markets put the situation precisely. Spare capacity is really only sitting in Saudi Arabia at this stage, with the rest of the producers effectively maxed out. The actual barrel addition would be exceedingly modest. Saudi Arabia was the world's marginal supplier of last resort, and everyone knew it. That position, which the kingdom had maintained through decades of investment in spare capacity, was now visibly and dramatically demonstrated to every buyer, every government, and every energy planner in the world. 5. When the crisis resolves and the strait reopens, Saudi Arabia will face a set of choices about how aggressively to reclaim market share versus how carefully to manage the transition back to a more normal supply environment. The temptation to flood markets will exist. Years of production restraint, followed by a crisis in which other producers cut output while Saudi Arabia maintained its position through the East-West pipeline, has created conditions in which Riyadh might calculate that the moment to press its advantage has arrived. A Saudi decision to maximize production in a post-crisis environment, combined with the return of shut-in Gulf supply from Kuwait, Iraq, and the UAE, combined with continued non-OPEC supply growth from the Americas, could produce the most severe oil market oversupply in history. The IEA had already projected a 3.8 million barrel per day surplus before the crisis added the complicating factors that are now in play. In a scenario where the crisis ends abruptly and all shut-in production returns to market simultaneously while non-OPEC growth continues, and demand has been suppressed by months of high prices, The arithmetic of global oil supply and demand could produce a price collapse that makes the 2015 or 2020 oil price crashes look modest. The crash risk is not hypothetical. It is the logical mathematical outcome of a market that has been artificially tightened by a geopolitical event and that contains enormous pent-up supply capacity waiting to be released. Saudi Arabia's Vision 2030 creates a genuinely complicated set of incentives around this choice. The economic transformation program that MBS has staked his legacy on requires sustained government revenues, which require oil prices above Saudi Arabia's fiscal break-even of approximately $80 per barrel. A price crash to $50 or $60 would be damaging to the Vision 2030 timeline, even if it was strategically advantageous in terms of market share. But Vision 2030 also requires that Saudi Arabia diversify its economy away from oil dependence, which means that the kingdom's long-term interest lies in capturing as much revenue as possible from its hydrocarbon reserves during the period in which global oil demand remains robust, before the energy transition makes those reserves worth less or potentially stranded. That calculation pushes toward maximizing production and market share now, while oil demand remains high, rather than managing prices carefully for a future in which demand may be structurally declining. The tension between these two objectives, protecting per-barrel revenues in the short term versus defending market share for long-term relevance, is the central strategic dilemma that Saudi Arabia's oil export strategy must navigate in the months and years following the 2026 crisis. The global oil market crash scenario, if it materializes, will not announce itself with a single dramatic event. It will unfold gradually as the factors that produced the price spike reverse and the structural oversupply that existed before the crisis reasserts itself. The Strait of Hormuz will reopen, whether through diplomacy, military action, or exhaustion of both sides. Shut-in production will return to market. The tankers that have been sitting in floating storage in Gulf waters, unable to load or offload, will begin moving again. Global inventory builds will begin. The risk premium that has kept prices above $100 will deflate. And unless Saudi Arabia and OPEC Plus coordinate a carefully managed reduction in production quotas to absorb the returning supply, the market will find its own equilibrium through the price mechanism, which means prices will fall until enough high-cost production becomes uneconomic. The question that Saudi Arabia's changing export strategy ultimately poses to global markets is whether Riyadh will choose to be the coordinator of that managed transition, using its unique position as the world's swing producer to prevent the crash, or whether it will choose to let the market correct and use that correction to eliminate the high-cost competitors whose growth has been eroding OPEC plus market share. Both options are available to Saudi Arabia. Both have been used before, and the choice between them will determine not just the trajectory of oil prices in the second half of 2026, but the shape of global energy markets for the decade to come.